Holy. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Germany has fallen. And this is something that we've been warning about for months, that things for the German economy were going to get far worse and then spread all across the Eurozone and then to the rest of the world. I'm going to show you what's going on in Germany, why things are going to get worse, and then we're going to answer the most important question. Can President-elect stop this from coming to the U.S. economy? I'm going to show you why it may already be too late. Now, let's head over to Bloomberg, where we picked today's story up with a headline, as recession risks roar back to life in Europe after weak PMIs. And a PMI is a purchasing managers index. And this goes out to purchasing managers in both the manufacturing and the services sector. And something we've been talking about is how the services sector follows the manufacturing sector, and yet what we're seeing is a somewhat revival in services throughout the world, and that led everyone to believe that this time would be different and that services would drive a massive turnaround in manufacturing. And what we've been warning about is that Germany's demise in its manufacturing sector that was plunging into a depression was not only going to bring their entire economy down, but it was then going to bring down the entire Eurozone, and after that, the rest of the world. November flash PMIs for France, Germany, and the Eurozone were released this morning and were weaker than expected across the board. And if we look back, the political elites were telling us that the services sector was going to drive the manufacturing sector higher on the fact that workers were seeing pay increases and that there was going to be a pent-up demand and they were going to come out and spend all this money in the economy. But what actually happened is the services side of the economy were forced to raise their prices, and what we saw is that workers' wages didn't increase fast enough. And what we suggested, what we warned about, is that consumers would reject higher prices, and sure enough they did, and that the downturn in the manufacturing sector was only beginning, and now we're seeing it's getting far worse, as manufacturing PMIs have been in contraction for longer than they ever have been before for Germany, and almost the longest in France. And there is a point when you see a continued long expansion that eventually it doesn't just lead to workers seeing their hours cut, it leads to mass unemployment. And right now, Germany is on the cusp of that. And when that happens, it's going to take the rest of the Eurozone down. And then we'll look to the U.S., where we see we're already in the early stages of where we're following Germany right down into a depression. As German business activity falls at the quickest rate for 9 months amid renewed weakness in the services sector. So I want you to understand there is a strong correlation here. A lot of people believe that the services sector alone is strong enough to drive manufacturing, but they don't understand the link between manufacturing and services, which is why downturns in manufacturing lead the services sector oftentimes by about 3 months. Now, this time we've seen a little bit different effect because of the pandemic stimulus that spread all across the world. But nevertheless, the relationship between manufacturing and services didn't change at all. Business activity was falling now for the 5th month running and at the quickest rate since February. So what we're seeing here is an acceleration to the downside. And this typically happens. You see movements in the economy toward the downside and then a plateau. And then everybody gets excited that the bottom's in. And then you see another move to the downside. And that's exactly what we're seeing now. Sustained weakness in manufacturing production was compounded by the first decrease in services activity for 9 months. Now remember, that wasn't supposed to happen. Wages were rising, and this is what the political elites were concerned about. They're saying, look, there's a big increase in wages, and that's going to go right into services, drive inflation, drive consumption, and drive manufacturing. And now we're seeing the exact opposite happening because weaker demand for goods and services led to further job losses, which is exactly what I've been warning about during the year's penultimate month. Services business activity fell in contraction for the first time in 9 months in November, now at 49.4, signaling the first contraction with the index under 50, finally succumbing to a sustained downturn in inflows of new work across the sector. Survey firms commented on uncertainty among customers and highlighted fewer new orders from manufacturers. And this is something that a lot of people don't understand, is the relationship between the manufacturing sector and the services sector, is that manufacturers demand services. So when their business is booming, well, that gets, of course, orders into the services sector. It's not the other way around where services drive manufacturing. So the sustained downturn in manufacturing was eventually going to hit the services sector, and now it finally is. Falling goods production remained a major drag on overall economic performance midway through the final quarter of this year, with manufacturers themselves suffering from a lack of incoming new work. Although easing for the second month running to the weakest since June, the rate of the decline in the factory output remained. And this is a dangerous sign because, again, the longer you see a contraction in manufacturing demand, when you see new orders drop, you see backlogs start to get worked through, and eventually it impacts the labor market. As more people lose their job, their spending power decreases, and then that back feeds into the economy. It's virtually impossible to turn around. Of course, we're going to answer the question later. Can President-elect Trump turn around the U.S. economy fast enough, or is it already too late? With inflows of new business continuing to contract across both monitored sectors in November, there's another broad-based reduction in backlogs of work. And this is critical because when the workers run out of backlog, something we've been wondering about for a while, and there isn't enough new orders to sustain the workforce, there's going to be more layoffs. And not just a few, there's going to be mass layoffs. The lack of pressure on business capacity, in turn, led to further job cuts across the private sector, which extended the current sequence of decline in employment to 6 months. A more modest fall in services staffing level meant the rate at which the overall workforce numbers decreased was the slowest for 3 months, although it was still steep and among the quickest seen over the past 4.5 years. And the layoffs in the services sector weren't supposed to happen, but now we're seeing them. And this is all function of not just a lack of demand from, of course, consumers, but lack of demand from the factory sector as well. And what this is leading to is more people are losing their purchasing power as their jobs are lost. And you're going to watch in the coming months, we're going to see even further contractions in the German economy that is rapidly going to spread all across the world, because as long as there isn't enough back orders to support the existing workforce, there will be mass layoffs and there will be no opportunities for them to get back in the workforce. And we can see this very evident when they talk about capacity utilization. When you see a decline in that, as we look at the US data here in blue, what it leads to is people losing their jobs, and there aren't other manufacturing jobs for them to turn to, which is why you see as capacity utilization shown as a percentage of the factory being utilized decline, you see an equivalent rise in the unemployment rate, which suggests that despite the fact that the experts here in the U.S. are saying that the unemployment rate is going to come down, unless we see capacity utilization turn up and turn up marketably, what we're going to see is the unemployment rate continue to rise as we see more Americans lose their job as the demand continues to get eroded here, just like we're seeing all across the Eurozone. Inflationary pressures picked up across Germany midway through the first quarter, with both input costs and output prices rising at the quickest rate in 3 months. Now, I know many people said, yes, you can get rising inflation no matter what the condition is, and yes, you can, but it's going to be transitory, because if we already know that workers can't afford the current prices, well, there's no chance they're going to afford even higher prices. And this is a huge problem, not just for the German economy, but for the entire global economy, because if demand is falling and prices are rising, well, it's a sure sign we're going to head into a recession. And this owed exclusively to developments in the services sector, where firms raised charges to the greatest extent since April amid a steep and accelerated increase in operating expenses. So they had no choice. As their costs went up, they had to raise the price of their services, and that's going to have a huge impact on the German economy and, of course, the global economy, as we see services sector businesses raise their prices amid the fact that we know consumers can't afford them. And this is going to mean that people are going to have to look to other ways to make money, and one way is in the market. And you can make money trading. You can trade fact right alongside with me. Let me show you how easy it is. Every day we publish 2 reports. One, we look at the machine positioning, and this is important because the machines are kind of like the Federal Reserve. They follow the market. So when they get in deep short positions, the market moves against them, they become massive buyers. And we look at all the signals our report generates, including we have all the back-tested signals built into the report, so you can see all the high probability trades. And I review them every day. I look at every trade the report suggests, give you my opinion on them, and then I disclose which trades I'm in before I make the trade, so you know exactly what I'm trading. But we also look at momentum because it's a big driver of markets today, and we look at that that over multiple time frames. And when we see a shift in momentum, well, it flags on our report. And now, of course, we've done a full back test on this too. So when the trades come up, I review all of them. And again, any trade I'm about to place, ahead of time, and we make it that easy. You want to make money? We give you our daily reports, our tradable signals. I go through every trade. I even disclose my personal trades to you. We give you full back test data, stop loss levels, all tracking of trades in return, a weekly update, a fully duplicatable system, and here's the best part, a 30-day free trial. It doesn't cost you anything to try it out and start making money. Join me right alongside, and I'll show you how you too can make money in this market, because if going forward, a lot of people are going to need to make extra money. And I'm going to show you why what's happening in Germany could be a danger sign for the U.S. economy as we look at the consumer price index in blue against advanced retail sales in red, both on a year-over-year rate of change. So what do we see is going on in Germany is prices are rising, demand is falling, and what happens, at least here in the U.S., well, that puts you right into a recession. We see that happen once again in the global financial crisis. We see it happen right around 2012 as well, but suddenly the world turned around and we escaped what was looking like a double-dip recession. How about now? Well, we're seeing retail sales flatline at just marginally over zero. Of course, inflation adjusted, we know it's negative, but the issue here is you might be saying, well, inflation's coming down. The problem is inflation's still too high. We don't have to have that direct relationship, but we're going to be watching the holiday sales, and what we just heard from companies like Target is that consumers are spending less, and that's a huge red flag, because if prices stay elevated and spending drops, well, it means for U.S. workers, they're going to be facing the same thing as their counterparts in Germany. The inventory cycle for purchases shows no sign of turning around after more than 20 months of destocking. It's similar for finished goods. Given the political uncertainty, we don't expect any big changes in the near future. Well, it's not about politics. It's about the fact that they're seeing prices rising. So if you're a retailer or wholesaler and you see prices going up and demand going down, you don't want to stock a bunch of expensive inventory in the hopes that maybe the manufacturers will cut prices. And so there's a risk here, because if you stock expensive inventory and it doesn't sell, you've got to have to discount it. You're going to take a hit on the margin. And a lot of businesses right now can't afford that. So what they're doing is they're only buying the inventory they need, and they're hoping to sell it fast enough that they don't get stuck with those higher priced inventory. But let's turn to France, because we talk about what happens in Germany spreads across the entire Eurozone, and now we see the French economy shrinks at the fastest pace since January, denting business confidence. Now remember, all this surge in confidence, and everyone said, hey, that's all it takes is we need consumer confidence to rise. We need business confidence to rise. And what happened in China? They said, well, wait a minute. Confidence went up and people didn't spend. What do we see in the course of the Eurozone? Business confidence went up, but people didn't spend. What are we going to see in the U.S.? The same thing. Why is it? Because incomes are not keeping up pace with inflation. We see here weaker demand was common theme seen throughout the company anecdotal responses during November, as we see the manufacturing PMI at 43.2. You want to talk about strong recession headed into a depression? There's your print right there. And what's it doing? It's pulling the services sector down, 45.7 now in contraction. New order volumes contracted at the steepest pace in 4 years, and what that's telling us is the global economy is now on its next leg down. We're getting confirmation here of what's happening in Germany, spreading to France, spreading to the rest of the world. A sharper fall in new orders led French businesses to channel more resources toward completing backlogs of work, because if you have workers, you might as well complete the backlogs. When those are done, you send them to the unemployment line. As outstanding business volume subsequently decreased for a 16th month in a row during the latest survey period, making us wonder, when are the backlogs going to be done? Moreover, the pace of depletion was the fastest in 4 years, with both manufacturers and service providers registering greater reductions in pending orders, suggesting we may be very close to the end of the backlogs. When that day comes and the fax machines don't work enough with new orders, well, watch out. There's going to be mass unemployment all across the Eurozone. And if you think the U.S. is immune, well, hang tight. Because looking north, UK PMIs were also just released and were weaker than expected across the board as well. The manufacturing new orders to inventory ratio, which leads the headline index by about 3 months, is turning down, which foresees no short-term respite for the PMI. Implied recession odds in the UK are likely to move toward those for the Eurozone, but as it stands, Given how entrenched the slowdown in Europe has become, it would make more sense that the likelihood of recession in Europe remains higher than in the UK. But keep in mind, we see the UK economy is following, of course, the Eurozone economy, where one goes, the other falls. And we can see some evidence that things in the Eurozone are getting worse as Bosch to cut 5,500 jobs as auto industry slump deepens. Remember, we said there would be knock-on effects. You see, of course, the manufacturers, they have a slowdown, they start laying off, and then eventually it starts to move down the chain, now hitting Bosch. It's going to hit the services sector in a big way too. Just hang tight. Because the automotive industry is suffering from significant overcapacity, adding the actual number of reductions will be determined in negotiations with labor representatives. Competition and price pressure have continued to intensify, and it's simply because we're now in an economy where there's way too much supply for the amount of demand, and that is a huge problem. Because European car production hasn't recovered to its pre-pandemic peak of close to 16 million vehicles, executives are now slimming down their operations to prepare for permanently lower demand. And let me tell you why that's going to happen. Is first 2 points to this. One, it's the baby boomers. We know they loved cars. They loved driving cars and buying cars. And many households, they had more than two. Well, as they enter retirement, they're finding out that they're not driving as much and cars are expensive, and they're cutting back, now going down to about 1.5 vehicles, soon to one. You watch them do this. But there's the other factor, and why I think there's going to be a huge change in this hybrid work from home movement is because people aren't driving. If you don't drive, you don't wear out your vehicle, you don't buy a new one as often, and that means other workers, not just here in the US, but all over the world, are going to lose their job. And you're going to see, you watch, there's going to be a push at some point to get people back into the office, to get the economy to turn around. But let's turn to the United States, where we see the global flash US PMI as output growth accelerates. As business mood brightens and inflation cools, does this mean we are an island, or are things going to get worse here? We see the flash U.S. manufacturing PMI at 48.8, still a mild contraction, and the services sector shooting higher to 57. But remember, that's exactly what happened in the Eurozone. We saw the services sector rise, the manufacturing sector contract, and everyone said not to worry. Well, maybe we should start worrying, because the sharpest rise in demand for 2.5 years and improved business confidence led to the big increase. Firms' expectations of output in the coming year rose to the highest since May of 2022, attributed to the prospect of lower interest rates. We're going to put that one to the test. Improved economic growth, I've got a big question mark there, and more supportive business policies from the new administration in 2025. That one where it can't actually validate, because we don't know which policies are going to be enacted and what the economy is going to do in response to that. But we can look at the fact that when you see cuts in the funds rate, it makes no difference, because I want you to understand the Fed lags the data. They react to what happens in the economy. Let's take a look here at manufacturers' new orders of durable goods, shown in blue on a year-over-year rate of change. And what do you see here? Right around 1994, a slowdown. What happens? The Fed reacts after the fact. What happens around 1997? A slowdown. Then the Fed reacts. You see the next slowdown, probably around 1999 starts. The Fed doesn't come into play until late 2000. How about the next one? You see here right around 2006, slowdown in manufacturing. The Fed's still hiking until close to 2008. That's right around 2007. The Fed finally gets a clue and starts cutting. You see the same thing happen here right around 2018. There's a slowdown. The Fed doesn't figure it out till later. And now in around 2022, we see a marked slowdown in durable goods new orders that are in contraction. The Fed now saying, hey, we're just going to cut a little bit because we think that's all it needs. And yet what you see is optimism at the manufacturing level jump. You're seeing production jump because they believe that means consumers are going to come out and spend. What they don't realize, the economy here is already in a downturn, already in the early stages. Question is, can President-elect Trump turn it around fast enough, or is it too late? Employment fell for the fourth successive month, while output price inflation cooled to the lowest since prices began rising in June of 2020, with prices charged for services showing an especially modest rise. So what are we seeing here? Further layoffs in the U.S. economy amid higher prices. We know that's going to lead to less sales, less demand, and you're seeing all the same setup we saw going into the last two recessions. And that's the risk here for the U.S. economy, is that we're already on the glide path down. The question is, can President-elect Trump change it? Or with 2 months to go before he gets into the office, is it far too late? Right now, from what we're seeing, it looks way too late. The services sector will be impacted by weaker manufacturing, and if we don't see U.S. consumers come out and spend big, and we see a continued deterioration in the U.S. labor market, well, you're going to watch both results. You're going to see the PMIs across the board both plummet, and what's happening in Germany across the Eurozone is soon coming to America. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.